Alex Coffey is with me, co-host of Next Gen Investing. The opening bells have rung, Alex. We've gotten in our durable goods a little bit weaker, a little sluggish, but big picture here, I think people will take a winning week on Wall Street. Some of your thoughts?
Yeah, I echo that sentiment almost entirely, Nicole. Good morning to you. I mean, at some point, there needs to be a couple red days to keep us honest here. Now, doesn't necessarily mean that it'll be today. It doesn't necessarily mean that it's going to be significant, but the market's not going to go up every single day into perpetuity. It just doesn't work that way. We talked a little bit yesterday about the seasonal effects and how this next 3-4 month period is a little bit more choppy and sideways historically. So something to consider as we look at that. But month to date for July, it's hard to, really be disappointed given the run-up that we've seen. Now, this chart we have on the screen is the month to date trade for the S&P 500, and you look at it, through yesterday, obviously a really nice day. And so all things considered, looking at this, Nicole, this is a 1 standard deviation channel surrounding it, basically showing that, the move that you've had thus far through this month is totally within a normal condition based off that linear regression, which is that yellow line. So, we want to, I think, put in perspective that this hasn't been, this dramatic melt up, bubble-like move in July. It's been methodical. It's been well contained. It's just been a strong month, all things considered, building on what's been a really, really strong start to the year, even after the huge drawdown in the first quarter.
What's interesting is I was going to say market breadth also has improved some, right? We always look to tech, but utilities have done well. Today, we started off with some up arrows in many, though now some are turning red, but materials, healthcare, consumer discretionary, and utilities. We have seen some broad-based gains. Like Deckers today is up 11%. That's a winner while Intel pulls back. And next week, we'll see a slew of earnings, right, including Boeing and Coinbase and Qualcomm and Microsoft and Meta, et cetera. Lot coming in our way.
Yeah, Amazon as well. So, yeah, you have some heavy hitters next week, no doubt about it, Nicole. Apple as well. So, several Magnificent Seven names. You talked to Boeing as well, which we know is an important part of the story that has seen this broadening to places like industrials, for example. But what I like to look at is just how many advancing issues are there in the S&P 500 on a daily basis. Well, right now, it's about 60% of the names are higher on today's session. So, all things considered, not a bad start to the final trading day of the week. And the NASDAQ, it's a little bit lower. Let's call it 55%, which makes sense. The NASDAQ's the weakest of the bunch. But all of these moves are relatively contained so far. So we'll see if they break one way or another. Gold a little bit weaker today. It was weaker overnight as well. So what I'm focused on is, hey, NVIDIA's a little bit lower. Microsoft's a little bit lower. Netflix a little bit lower. Amazon, Coinbase, Baba, some of these names that tend to cluster together have been winners, all a little bit weaker and sluggish to start the day. Alphabet as well, sort of teetering around that unchanged line. If those names start to break lower, they could drag down the rest of the bunch. But everything is so close to unchanged right now, it's probably too early to glean which way this is going to break.
Even the VIX, which I've been watching, it has trended a little bit lower. I'll say in June it was more in the 16, 17. Now it's in the 15 range. What are your thoughts?
Yeah, I think the story remains intact, Nicole, when you look at the VIX. So this is obviously the spot VIX chart as you look at it over time. And really what this, shows is, hey, volatility has dramatically come down from where it was at its peak of the fear. So despite the fact that maybe some of the headlines are similar when it comes to tariffs and the uncertainties that we're still talking about, but sort of the shock factor has really worn off, and you've seen fear come out of the market dramatically. However, if you were to look at the VIX curve, which is rather than just looking at the spot VIX over time, you look at, let's say, VIX futures in August versus VIX futures in September and October and November and December over time, what you would see is right now there's not a lot of fear, but as you start adding time to the equation and going further out, more and more fear is priced in. So if we were to look at, for example, the December VIX future, it's at 21.1. Well, right now, VIX is at 15. That's a tremendous premium versus where we're at right now, like a 40% premium on volatility. So for those who are hedging and buying volatility, it's quite expensive as you go out in time, but it's relatively cheap on a short-term basis. So what does that mean? Well, it means if you're able to time whenever we have a drawdown, it could work out really well, and you might be getting a relatively affordable volatility. However, if you're going out in time, you're buying December, January, or even further, you're really paying up for that as the market understands there are uncertainties and there are risks. We just don't see them taking place today.
All right, Alex Coffey, great to see you. Thank you so much. Appreciate it.